can you give me an idea of things, just the path for the Fed funds rate at the moment? Because we're having this conversation, the market is not priced for it. There is this conversation about Fed funds peaking somewhere north of 2. I'm trying to understand where you are, sir.
I think 2 is preposterous. We're looking at 40-year highs in inflation. What you're talking about when we talk about the consumer seeing high prices, well, guess what? They're going to want higher wages. And there you go. There's the nefarious wage price spiral for everyone to see. So it's here now. I think it's frankly too late for the Fed to engineer a soft landing. They now have to focus on getting inflation back down. And by the way, when we listen to all the corporate finance activity that's going on today and over the previous year, that's another highlight that the cost of financing is too cheap. It's too cheap for businesses, it's too cheap for households, and it's too cheap for governments, and they've binged on it. So there's a lot of normalization and tightening ahead for the Fed. I think we're going to see a Fed funds rate that's going to get to 3% minimum in this cycle. And by the way, it's not so preposterous to get to that level. We got to 2.25%, 2.5% back in 2018, and I think we were on track for 3% if we didn't get into a trade war before then.
Bob, this feels like end of cycle type stuff. They can't engineer a soft landing. They've got to take the Fed funds north of 2. 2's preposterous, get to 3. I'm trying to work out what you're doing then within the portfolios at the moment, Bob. Late cycle trades, end of cycle stuff, what are you doing?
Well, I think that's it for bonds. I think bonds have a lot of repricing ahead, and without central bank backstops there this year, and I think other central banks will end their large-scale asset purchases, and some will begin to run down their balance sheets, then you're leaving it to people like me to price. And we're not going to take negative real yields. We're going to want positive real yields. And that means a lot higher pricing. That means bond prices go down. I'm trying to hang on to credit because I like credit spreads in here. The problem is most credit spreads get attached to a total yield, and I see those yields going up as well. So I think in this market, you're supposed to sell any bond market rallies if you get them.
Wow.